We know that there are all sorts of new investors, a lot of them younger. Some have a certain amount of education, some are less sophisticated. A lot of them want to learn, a lot of them want to trade. I mean, there's all sorts of different types. But so, just a hypothetical. Let's say this person is 27 and they're learning and they want to invest, and maybe they're using ETFs, maybe they're trading. They got caught up in GameStop, but give advice to a younger person. Maybe give advice to a younger John O'Connell who's just kind of getting into it. You could go anywhere with that, I know, but what are three pillars of wisdom that you would sit down with somebody, a young person, and say, okay, here's you got some money. Here's what you want to do to create wealth long term.
Well, first, I think it's great that young people are getting involved and engaged in the capital markets. That really grounds them and roots them in the economic activity of the world, which I think is a real positive. And they're engaged and they're allocating their money towards things that are important to them. That's fantastic. I think the most important lesson that young people can think about, it's hard because it's boring, but it works tremendously well, is the power of compounding interest. The younger you are, the more you save, you can earn really, really low rates of interest and let that money just compound for you long term. You don't need to make all the money in the first month of your career of investing. So the second thing is, first, let compounding interest work for you. Number two, have an objective in terms of why it is that you're investing. And so have a goal, have a business plan in terms of what it is that you're trying to accomplish. And third, make sure that your time frame is a reasonable time frame. So make sure that you're not trying to accomplish unreasonable things in a short period of time. You know, we hear about people winning the lottery and we hear about people winning huge sums of money buying Bitcoin or Tesla or GameStop. But the issue is that those are the abnormal situations. The real is getting wealthy over time, having an objective, letting that time work for you and letting your money compound, you'll be rich. That's simple.
Have you noticed over the years, John, in dealing with your clients that everyone's different and they all have maybe different risk tolerances and personalities, and it takes them a while to come around to your kind of thinking, or they're stubborn and you can't get through to them and they say, okay, if you want that stock, I'll buy that stock for you. What's your experience in terms of dealing with various clients?
You know, the people that have a long-term demeanor always end up doing well. The ones that are saying, I'm going to go out and beat the world, I don't know that many that actually really did it. The problem is that one of the biggest slayers of performance over time and with a high degree of eventuality is overconfidence. And so one of the worst things that can actually happen to you as a young investor is having tremendous success earned over a very short period of time. It tends to overbreed confidence. Overconfidence tends to lead to overtrading and over enthusiasm and taking more risk than you actually have to have. So once again, go back to what your business plan is. What are you trying to accomplish? And if you're trying to get rich quick, the stock market's not a very easy place to get it accomplished. So just be really careful, have a goal, let the money work for you, allow for compounding interest, and have a long-term objective.